in some of these big states, state and local tax deductions, an individual is a big deal. You take that out. The Senate plan does not. And
well, they take it out completely.
Yeah, they take it out, but you still have it in, I'm saying.
Yeah, right. So here's what we say. We say, because we want to get everybody's tax rates down across the board, and the analysis shows us that taxpayers in all states get a net tax cut, but there are clearly going to be individuals that utilize really big deductions that may not do so well. But we believe everybody will benefit for two reasons. Almost everybody every income group on average gets a tax cut, but the economy is going to grow. You're going to get faster wages. If you're a high-income individual with a big tax loophole, you probably have business income. You probably invest in a corporation, own a small business. Those tax rates go down. And we're lowering your tax rates all the way down on every dollar you make up to that really high tax rate. So here's the point I'd say. We looked at the numbers, and 90% of all Americans pay less than $10,000 in property taxes. So we are saying let's keep the property tax deduction for individuals up to $10,000 because we can capture just about everybody in America. So we're saying in addition to having your higher per child tax credit, in addition to doubling your standard deduction, in addition to lowering your tax rates, let people have their first $500,000 of mortgage, write that interest off, and in addition, let people write off $10,000, up to $10,000 of their property taxes. That helps especially those people in those high tax states. I've got friends and family in Maryland. I know that's one of those states. So they have really high property taxes. We want to make sure that people enjoy this across the board, and that is why we added back into the legislation in the House to be sensitive to those people in those high tax states, the additional ability to write off your property taxes up to $10,000. You do those things, and that means the vast majority of people in all these places are better off.
But, you know, the people in New Jersey, New York, Illinois, California, they are very upset that they are losing the majority of that state and local tax deduction. They're saying, why does it have to be on our backs? Why, well, for example,
first of all,
why doesn't the government
Wisconsin's
cut some spending?
a pretty high tax state, and we lose it where I come from, too. But, Martha, here's what it is. You can either stick with the current code with these really high tax rates and all these different tax deductions, or you remove these tax deductions and lower everybody's tax rates across the board. And so, yes, if you have a very high tax state, that deduction is richer for you. That deduction, because your state cost of your state government's higher, that means you have a higher deduction. So let's just take New York versus Wyoming. I suspect that Wyoming's taxes are probably lower than they are in New York. So that tax deduction is not as valuable for a person in Wyoming as it would be in New York. But what we're doing, and it's really important people look at this in totality, by doubling the standard deduction, letting people write off $10,000 of tax of their property taxes, lowering their tax rates, you're seeing benefits across the board for all families across the income scale.
But corporations get to keep the state and local tax deduction, right?
No, corporations are taxed differently. So
in some cases, they get to keep the state and local tax deduction.
No, corporations go from 35% down to 20%, and they have full expensing. Expensing, you don't get to write off your property. You don't write off that. Corporations write off their plant and equipment investment. When they buy a factory or they buy equipment, that they can write off.